Bom dia a todos. Vou tentar em português. Sinto-me verdadeiramente honrada e entusiasmada por estar hoje aqui convosco. Para quem não me conhece, sou a Nadina Kawi, a CEO de Allianz Trade em Portugal, e nos últimos 26 anos tenho trabalhado para o grupo Allianz em diversos países, diferentes países e cargos. Tive esta posição há 8 meses e posso dizer que fui recebida calorosamente por todos neste belo, mas chuvoso país. Chuvoso. Because since I came, it's been raining a lot. I was promised a sunny land. Para uma grande... Quero também confessar uma coisa. Para uma grande apreciadora do fado como eu, viver e trabalhar em Portugal, a terra do fado, é a cereja no topo do bolo. Antes de mais, quero agradecer-vos por estar hoje aqui conosco e pela confiança que depositaram na COSEC e agora na Allianz Trade. A mudança da marca não acontece para apagar aquilo que a COSEC representava, mas antes para construir a partir do seu ADN, o ADN da COSEC. Credibilidade, solidez e foco no cliente. E estes são também os valores que representam ou que caracterizam a Allianz Trade. Como uma presença em mais de 50 países, a Allianz Trade acrescenta sinergias globais, mas também capacidade de risco e mais colaboração e inovação. Mas no âmago, a essência da COSEC prevalece. Na Allianz Trade, acreditamos que o nosso papel vai além de vender seguro de crédito. Com a enorme base de dados que temos à nossa disposição, a nossa missão é também partilhar convosco mais informações para ajudar-vos a navegar melhor neste mundo em constante mudança. E por isso, com os nossos oradores de hoje, Paulo Portas, Ana Boata e os membros do painel, espero que podermos ajudar-vos a mais compreensão para o presente e também mais clareza para o caminho à nossa frente. Este evento marca o início de uma série de eventos que queremos ter convosco, com formatos diversos. Espero que gostem do evento. Agradeço mais uma vez a vossa presença, o vosso tempo e a vossa confiança. Obrigada.
Bom dia. So you have understood it's a great balancing act. This is how we call our economic outlook, because it's a great balancing act between business opportunities, but in areas where the risks are not too high, right? So we need to balance between business opportunities and risks, knowing that it's very difficult to actually protect against geopolitical risks, right? Usually companies know about those geopolitical risks, but what can you do in order not to take the wrong decision and to increase too much your protection costs for risks that might not realize, right? Over the past years, we have seen that a lot of the downside risks have realized, but still, I think it's worth looking at the central scenario, which is ours, Allianz Trade, but also thinking about these alternative scenarios, the what could go wrong, right? Because we need to be prepared in case these extreme events happen. And we need to know what to do next and to be rapid enough in order to act and protect our bottom line and to protect our business, right? But before that, because there was a long presentation, I just wanted to do a pulse check. So what are your expectations in your sectors for 2025? Are you more optimistic? Please raise your hand. Not optimistic? A couple of them. Are you feeling more of the same? Do you think 2025 would be more like 2024? Okay. And then the last one, are you more pessimistic about 2025? So the good news is that the pessimists are a minority. Now, the bad news is that everybody expects more of the same. So actually, the optimism is not really here. And I would say that it's a bit our scenario, right? It's steady, but no stellar global growth ahead. It means that if you look at the table, these are the forecasts that Allianz Trade does on a quarterly basis. So this is Q3, so we did them for end of September, so they are really fresh, fresher than the IMF, which does them twice per year. We do them four times per year. And you see that we are at this 2.8%. Which is a plateau of growth, and it's below the 3%. And 3% actually it's important because it's a level of growth that allows for much more employment, for much more turnover growth, for much more investment from companies. And then you see that if you look into the details in the column of 2025, because 2024 it's almost done, you see that there's a lot of heterogeneity. The US actually stops to be one of the growth engines, right? After 2 years of surpassing expectations and even surpassing its potential growth, which is actually 2.2%. So you have seen this 2.5 already earlier, 2.6 expected for 2024. It might be even higher because we have had some couple positive surprises over the past weeks in terms of some of the data. And then you see this landing at 1.7. Because they never landed. They never landed after the period of very high interest rates. And why they didn't land that is because 60% of the increases in interest rates have been compensated by fiscal policy. So of course, if the government implements subsidies and implements fiscal easing through tax cuts for households, for corporates, of course that the central bank, if it increases interest rates, is not really visible. And this is what happened in 2025. It's expected to be more difficult because whoever wins the US elections, it will face a divided Congress. So they will not be able to do whatever they want, or at least whatever they announced. The only major risk in the room, of course, is whatever a Trump policy would mean for global trade, because this is what he can do, and this is what he has done also in the past, in the previous presidency. But then you see that we expect this acceleration in 2026. And a lot of it has to do with interest rates, of course, but we'll talk about that later. Then we see Europe that didn't grow for more than 5 quarters. We were landing, of course, but it was a soft landing, but a long one, because we didn't grow for more than 5 quarters. And actually, we expect this 1.4 in 2025, 2026. But if you look into the details, so it's slightly above potential. It's interesting to understand that there's already 1 percentage point in terms of potential growth between the US and the Eurozone, right? So that's a huge difference. So between 2.2 and 1.2. So it means that, well, we grow slightly above potential, but it's more for me a catch-up than rather really growing above potential. And you see that Germany actually is in its 2nd year of recession in 2024. And it will slightly accelerate in 2025, knowing that I have another slide, which we didn't really talk up to now. There are German elections next year. And it's a very fragmented political scene. And already they don't agree in a sort of stable coalition. It will be even more complicated in a grand coalition, where the center right and the center left will need to agree on things. And then we have, of course, France, which probably is exposed to much more downside risks than upside risk. And this 1.4, 1.2 might look a bit optimistic. But there's a saying in France, you know, it's not because your fiscal deficit is at 6% of GDP that you will actually do what you say you'll do, right? So it's not because the government, which is actually a technocratic government, will say that they will adjust to 5%, that they will be able to adjust to 5%. So I think we will be in a situation where France will not deliver what he says. And so what? The European Commission probably will not be able to implement all its fines, just because France is too big to fail. And we will be in this environment where, at the end of the day, the French economy will muddle through, right? And we'll probably even face early elections again in 2025. But we will avoid the recession that Germany has, because France it's diversified much more on services and less on industry, and definitely not so much exposed to high energy costs, and definitely not so much exposed to the death of the car industry in Germany. And then, of course, we have the Southern European countries. It was already mentioned, but I think it's worth to talk about Italy, which is a bit in the middle, right? But definitely Spain, which has been the major outperformer of the Eurozone over the past 3 years. everybody constantly revised on the upside its expectations for Spain. And actually, Spain grows by 2%, 2025 and 2026. And it's not that much above potential, because Spain has also higher growth potential than the rest of the Eurozone. And Portugal, in this environment, this 1.5, 1.6, which is slightly above potential, Portuguese growth is around 1.3, 1.4 potential growth. But also has been surprising on the upside, right? Just look at 2023, clearly Spain and Portugal, it's a mixture of story of tourism, of course, but also next generation new funds, something we'll discuss later on. And then we have emerging markets, of course, China, that is on a slowing path. It's not a surprise, we were expecting that. And we know Chinese potential growth is 3.9. So it means that we didn't reach the bottom of the Chinese growth. And actually, that's ahead of us. So you see that in 2025, we expect 4.3. In 2026, 4. It could be actually even 3.9. Again, aligned with potential. If we grow more, like 5% this year in China, it's just because the authorities are pushing the economy out of a crisis, if it's the real estate crisis, if it's the consumer crisis. It doesn't mean they do enough, but they do enough in several pieces. So they announce whenever things are getting worse, they will act. And they act piecemeal approach, and they act enough in order to deliver on their targets. And the target is 5%. And probably next year, the target will be lower if they are pragmatic, as we know Chinese are. Never underestimate the Chinese capacity to get out of a crisis, because clearly the Western view is to look only at the issues China has, but actually China is able to reinvent itself very fast. Just look at the EV, it has been mentioned, they are able to actually produce high-tech EV cars, 30% lower prices than the low-end technological EV cars in Europe. And they are able to produce them from A to Z, so the whole supply chain in China. Now, of course, things are changing, and it doesn't mean that everything is dead in Europe, and we should not be overly pessimistic, but it will take time. It will take time to create factories of EVs. It's happening in Poland, it's happening in Serbia, in Hungary, but it takes time. And it will not be replaced in the next 5 years. So, of course, during this time, what's happening with those companies in Europe, because we have all read the news in terms of Volkswagen, right? Volkswagen is actually finding no investment for its Audi EV factory in Brussels, and they might close it for the first time in history. So a lot of things will still happen, and a lot of things in Europe at least will limit the strength of growth ahead. But emerging markets in general, they are bottoming out. They are coming from 3 years, 2 years and a half of very high interest rates, depreciation of currencies, high inflation, and now they are seeing the light at the end of the tunnel, just because the major central banks start to decrease interest rates, and then they are also able to do so, and there are less upside risks to inflation. And therefore you see across the main region, Latin America, if it's Central and Eastern Europe, if it's Turkey, if it's even Asia, out of China, so more Southeast Asia, but also Middle East, Africa, all the regions are going to see more growth in the next 2 years. And here I just plotted the quarterly growth, and you see that Portugal is actually slightly above the green line. So Portugal is the orange line, for those that are a bit far, and Eurozone is the green line, and we see that Portugal will continue to be slightly ahead of the Eurozone aggregate for the next 2 years. Now, of course, the big elephant in the room that nobody actually manages to anticipate well is the geopolitical risk. And of course, 2025, 2026 is a bit better if we manage to exit this uncertainty of the US elections as we would like it to, right? Which means, between us, no Trump presidency. If we manage to avoid that, it means that we have basically survived a very political year, which has been 2024. In 2024 only, we had 50% of the global population that voted. And believe me, it doesn't happen every 20 to 30 years. So it was really a concentration on a lot of political risks in 1 year. Now, looking ahead, of course, the US elections, we discussed that. It has been greatly discussed. So I think, again, what we need to keep in mind is that whatever the president, if it's Kamala Harris or if it's Donald Trump, the Congress will be divided. And that will reduce the strength of what they want to do. If it's Kamala Harris, she's obsessed about fiscal policy. She's obsessed about basically correcting the very high fiscal deficit that the US has. And by the way, that nobody cares about, because we talked about France, but the US has almost 8% of GDP of fiscal deficit. France has 6%. And then, of course, it will also depend on the power of the Congress to limit also some of the main craziness of decisions that Donald Trump might want to take. If it's about fiscal policy, because he on the contrary, wants to cut taxes again, if it's about foreign policy, because we heard about him wanting to fix the war in Ukraine in 1 or 2 days. We know what is his position in the Middle East, and it might mean more escalation between Israel and the new forces. Yeah, clearly it can have consequences. It can also have consequences between in the conflict in the South China Sea, right? Because we know it's a very fragile equilibrium between China and Taiwan. And actually, when you talk to companies, the main worry are not the US elections. The main worry is China-Taiwan. Because if there is a blockage of all the ports in Taiwan, you can imagine what will be the impact on global trade. Because we are not able to produce those semiconductors. We simply don't have them. Even if the US has a bit more, it doesn't have enough to save the world. So clearly that's the major risk that is ahead. And again, we might be wrong, like we were with Russia, but we believe that the Chinese, first, they are not ready to go into this kind of conflict, and second, they are pragmatic, and they also need Taiwan to be functional. But you see a couple of elections here, the most important, the German election, knowing that, again, we understood that SPD were not ready to probably govern, but we also clearly see that the CDU, right, the right wing, will not have the majority. So we might probably be in a sort of grand coalition, and you can imagine what will happen with Europe when we have so many things to do, and France will go every year potentially into snap elections with no concrete results. The only result that everybody's happy about is that the extreme don't have the majority. But having said that, it doesn't mean a lot of progress on the reforms. And then Germany, where there is a grand coalition, and the grand coalition doesn't mean much either. Because, of course, having agreements between the left and the right, it's always complicated. So it will be complicated for Europe in the next 2 to 3 years without having this French couple stable and able to actually function. And I think that's something that we need to keep a close eye on. And of course, everything that I say here, right, and the forecast that I present to you are based on an assumption, because we can talk about risks, but at one point you need to take a decision, right? And you need to understand what is your decision based on. And our decision on our forecast is based on a policy continuity in the US, is based on no further escalation in the Middle East, no other conflicts that are ongoing which will escalate, Russia, Ukraine, for example. And of course, it's also based on some political uncertainty in France, in the UK, in Germany. But of course, if on the 5th of November, Donald Trump wins, the scenario will look different. And the deviation from what you have seen, for example, on the previous slide, right, we have seen 1.7 for the US next year, it might go as low as 0.3 if he really implements what he says. So it means that we might be heading into the recession in the US, and of course with implication on global growth. But again, it's difficult to actually take a stance, right? So you work in scenarios. You know that if that event will materialize, this is how things will look like, and then you'll be able to act. So basically, the new thing is austerity, and we didn't see that for a while. And actually, we didn't see that thanks to COVID, because COVID has brought us a lot of support in terms of subsidies, in terms of state-guaranteed loans, in terms of unemployment benefit schemes, you name it. A lot of liquidity for companies, and actually that was not a financial crisis. But then, at one point, after 3 years, they said, well, we need to reinstate the fiscal rules because everybody's spending like crazy, but at one point, we need to ensure that this fiscal policy is sustainable. And you see here our expectations for 2025 and 2026 in terms of fiscal deficit. So, of course, No surprise, Portugal, Greece, even Spain, these are countries that have done the job in the past. And now they are better positioned in order to benefit from the fact that interest rates are lower, and they might actually issue probably more debt in order to finance some fiscal easing. And this is what we see in Portugal today, right? More than 3 billion euro have been announced in income tax cuts, maybe corporate tax cuts will come, and a lot of other measures. Electricity, VAT, reduced electricity VAT tax, a lot of them that support purchasing power from households and also investment to some extent. So I think it will go on, of course, if the political environment would allow for it, but the numbers allow for it, which is not true for France. We discussed it. Of course, France is not the worst. We have UK also, which also needs to adjust. We have Italy, we have the US, we have Belgium. So a couple of major economies in the world will need to adjust their public finances. Now, it's about the speed, right? Because doing 1 percentage point as France wants to do in 1 year, that would mean around 0.6 cost growth. But doing only half of that, it's more bearable. So let's see. There is still debates ongoing and negotiations, but I think we also need to look at the counterbalancing forces, right? So there are some things that happen, like excessive deficit procedures, like for example, for Italy. But it's also, on the other side, there is also still a lot of money that will enter in Italy, if they manage to absorb that, right? Something that France doesn't have. So I think it's important to keep in mind that a lot of the European funds have not yet been disbursed. And that's, of course, the European bureaucracy, which doesn't actually allow for those funds to be really fast implemented. But it also means that in the next 2 years, when these funds will need to be spent on, so by end of 2026, we still have capacity to absorb some of these investments that would create growth, that will create jobs. And you see that in Italy, we talk about 89 billion, which is roughly 4.5% of GDP. In Spain, we talk about 125 billion euro, which is actually 8% of GDP. And if we take Portugal, 14 billion, it's around 4 to 5% of GDP. So of course, it doesn't mean that we translate all these points of GDP into immediate growth, but it does mean that this will create business opportunities in some sectors, because all of these European funds are about digital, are about green, are about infrastructure. So if you work in those sectors that can grab opportunities thanks to these European funds, please keep that in mind. Of course, we are behind schedule, and probably you'll hear in 2025 that we prolong from 2026 to 2027. It might be. These envelopes need to be basically spent. But again, it can provide some upside to all this fiscal consolidation that is ahead in some of the Southern European countries, so basically in Italy, because if you look at France, 9 billion euro doesn't mean at all more than just 0.1% of GDP for France. But you see, right, we have Germany and France, major European economies, which didn't benefit from these European funds. It might be normal, but it also explains why they might struggle in not having growth as high as in other, for example, Eastern European countries or Southern European countries. And then what we are more optimistic about are the consumers, because the consumers, at least in the rest of Europe, not necessarily in Portugal, because there has been more consumer spending in Portugal than in the rest of Europe, but we see that actually there's a momentum that is building for consumers to spend more just because they have more purchasing power. Labor markets are still dynamic, unemployment rates are at record low levels, and wage growth is still relatively high, right? We talk about 3 to 4% on average in the Eurozone, which is much above what we have seen before COVID, with an inflation that is at 2% or even below. So in real terms, the consumer has more power to consume. Now, everything lies in confidence, because you can have money, but if you're not confident enough, you will not spend it. And this is where we look very closely at the evolution of excess savings, because we have seen that after COVID, very few countries have managed to deplete the excess savings. Basically, this is money that we have received while we were at home, couldn't spend, and we received a lot of money on our bank accounts. If it was the unemployment benefit, it was our salary, but without consuming. But clearly, if you look at the US, and to some extent to the UK, you see that there is an adjustment, especially in the US, which also rings a bell, right? It means that the Americans have been much more confident to use their excess savings in a period of high inflation in order to keep on the pace of consumption, which was not true in Europe. And you see also in Portugal, we have around 3% of GDP of excess savings, which again means a lot of upside potential for upcoming growth if we manage to basically give the confidence to people to consume. Confidence being by the political environment, by the next measures that will be taken, but also by anything that is demographic change. Because if you tell people constantly that we are too old and we need to work for much longer, and you do pension reforms, of course those guys will not be very confident to spend. But at least in Europe, we have this upside risk, which is not true anymore in the US, right? You see that they are at around 1% of GDP. So whatever happens in the US, if it's fiscal tightening, right, austerity, if it's, I don't know, another shock, the consumer will not be able to compensate because it does not have that much savings on their bank accounts to do so. And there's a reason to believe why we would see basically a rotation from services that we have had until now to more goods and more durable goods. We have seen a sort of catch-up, right? We have seen a sort of pent-up demand on services, and especially on tourism. People have been paying anything just to go and travel. And we start to see I would say, a glass ceiling, because these services prices have been increased massively. And I think we all have seen it also in our private or professional lives, that it starts to be sometimes unsustainable. And clearly we see now that the spending of consumers on services, and especially on tourism, is a bit more moderate, because people are balancing. And they are also balancing because there's a replacement cycle. When you buy a new phone, when you buy a new printer, when you buy a new laptop, you need to replace them at one point. And a lot of them have been bought 2020, 2021, right? So it means that in 2025, 2026, we might see a replacement cycle coming for some of these goods. And you see that, for example, Portugal is not that bad when it comes to the volume of durable goods that have been bought, right? So 100 is the pre-pandemic level, and you see that they are just after the US, right, in terms of dynamics. So it means that, to some extent, maybe some of the sectors might see less of a rebound just because of base effects, because people continued to some extent to buy those goods over the past quarters. But you see that in a country like UK or in a country like France, where we are below the 100, so it means that people bought less and less, there's more catch-up effect. So that would mean that if you are an exporter of those durable goods on those markets, you might grab a bit more market share. So overall, at the global scale, trade growth is expected to rebound. So you see here, we do talk about this landing a lot, and I think you heard about soft, hard landing. Well, there was a hard landing for global trade of goods, because global trade of goods has been in a recession for 1.5 years. And we have started to exit that recession in Q2 this year. So it means that by July, global trade of goods is increasing by around 1%. It's not that much, right? But when we look at trends, when we do our forecasts, what we do is that we aggregate country by country, region by region, and we look at the trade structures and who is able to gain more market shares. You see that we end up with not very strong figures, right? 3 and 3.1% is slightly more than global growth, right? The 2.8 that I showed you at the beginning, but it is below long-term average. So clearly, there's still a way to go before we see global trade being very dynamic, knowing that, of course, these forecasts are very dependent on the trade outlook after the US elections. Because again, what Donald Trump says is that he will increase tariffs across the board. So it's not only about China, it could also be about Europe, it could also be about Vietnam, basically the whole world, from 2.5% on average to 10%. And this is what it gives as an impact if he increases to 10% the import tariffs. It means, of course, more inflation in the US, probably higher rates in the US under a Donald Trump presidency, but it also means probably lower demand from the rest of the world, because of these higher costs for the US consumer, right? And you see Mexico, Canada are the most exposed, then China, US by secondary round effects, And then we have the new trade hubs, Vietnam, Taiwan, Korea, Brazil. In terms of European impact, we can see around 0.5 point of GDP. So it's not unbearable, but it's more than that, right? This is just a direct impact. But we need to look also at potential disruptions on the supply chain, just because some countries will not trade that much anymore with the US, or maybe because the US companies will try to diversify even more. So these are part of those risks that we carefully need to monitor when we are a company, because the main risks today lie in the supply chain. And the main risk is in the management of these supply chains, because even after COVID, I don't think, and we see actually, that companies are not fully aware of all their interdependencies of the supply chain. And it's getting very complicated. We have seen it also with the Red Sea disruptions, transportation, input shortages. It's getting complicated when you don't have access to those intermediate goods, or when the transportation cost is tripling, right? And then what it means for Portugal in terms of export opportunities, right? This is also something that we look every quarter. And actually we have a tool, which is called Trade Match on allianztrade.com, that you can look into and play around, right? Just to see on some of your markets what could be the export gains in the next 2 years. This is for 2025, so no surprise, main export market would be Spain. Brazil, that's new to me at this. Italy, UK, Germany, in the US, right? So we have a very diversified export destination pattern, I would say. In total, we have 4 billion euro. It's more of the same compared to 2023 and 2024. And then we have a lot of business and consumer services, so still a lot of tourism in these export gains, but also transportation services, which is also one of the resilient sectors in Portugal over the past years, which has not been true for other European countries. Software and IT, chemicals, textile, household equipment, electronics. So these are those durable goods that I was talking about, where we see the cycle starting to be more basically to take more speed, right, to rebound. And these are the cyclical sectors where we actually expect export orders to improve, right? This is the view as of September. So we look into, actually as of August, we look into the evolution of new export orders by sector, August 2024 versus August 2023. And if you're below, so on the left chart, if you're below the axis, it means that you're faring better. But if you're even more to the right, like food and technological equipment, it means that you're growing while you were not growing last year. So basically, best placed sectors, food, technological equipment, general industrials, machinery and equipment. So these are goods that were absent over the past years because nobody was really a lot investing, or consumers were not really buying those goods. And there are also some sectors that are adjusting, right? Because we all look for productivity gains and we all look for higher profitability at the end of the day, right? So we have plotted the new export orders with the employment prospects. And it's interesting to see that there are some sectors, so there are some that are faring okay, those that are in the cyclical growth. There are some that are searching for productivity gains on the left side. And there are some that are hoarding labor. And hoarding labor, it means that the activity is dropping much more than what the employment is. So it's construction materials, machinery and equipment, automotive sector, food. So either these sectors are waiting for the cyclical rebound, as we also expect, right? Or they are also waiting for some AI impacts, because everybody's investing in AI, but for now, you're not sure that those investments will bear fruit, and you will not lay off your people. Even if you know that you should, you will just keep them. First, in case the cycle is getting better, but second, also because if you need to hire them, you might take a long time to find them, and it will be also much more costly. So something to look for, right? Because if the cyclical momentum disappoints, there might be some layoffs in some of those sectors. And we are in an environment where real growth is bottoming out, but it's steady, right? It's in some economies is bottoming out a bit more, like Europe, Eurozone as a whole. But we don't have inflation. So it means that we are also preparing now for an environment where turnover growth needs to be much more driven by basically sales, right? But sales in terms of volume, not necessarily in terms of pricing, because the pricing is not really there as it used to be over the past 3 years. And you see, for example, if you're in an intermediate good type of activity, producer price indices are bottoming out, but they have been falling drastically. So clearly, in some areas, like for example in Portugal, now we talk about 2% growth year on year. So you can correlate that with your pricing power if you're in a manufacturing sector in an intermediate good segment, right? So good news, of course, inflation is moderating. This is what we're looking for. And rates are going to also moderate. So I'll just briefly talk about the upside risk on inflation, oil prices, because we still don't know what will happen in the Middle East. We see every week or every 2 weeks that the scenario escalates into what we were calling downside scenario, and nothing happens on the oil price, just because Saudi Arabia is producing much more, just because China is basically working out in order to create more growth domestically, and also because nobody in the market believes in an escalation in the Middle East. But of course, from this 79 in 2025, we might go up to 100. If really we have an escalation, which of course means Israel targeting some of the critical oil infrastructure in Iran, which again remains today a sort of tail risk scenario, but we have seen in the past that some of the tail risk scenarios have materialized. And then we have also some good news, but that might reverse if Donald Trump is winning the presidency in the US in terms of the euro-dollar, because the euro-dollar has been a problem over the past years. It has depreciated quite a lot to levels that were not expected. And I think all of us in the room have been surprised and even wondered if it will go below parity. And now we actually see this 110 being stable, 110, 111, just because there's less differential also between the central banks. Every central bank is cutting interest rates. Growth differential is also less strong. The US is slowing down. Europe is accelerating. So they meet in the middle, right? And meeting in the middle is this 1.10 level for the euro-dollar. So it means that if no alternative scenario is materializing, and most importantly, the US elections, which is inflationary again, and which will mean that this Fed curve, this dark blue line, will not actually materialize. So if this doesn't happen, right, if we have policy continuity, you see basically that we are going to see a progressive cut in interest rates by fall 2025. And end of 2025, we see rates at 3.5 in the US and 2.25 in Europe, right? So it's better, but it's still not very accommodative. Because if it would be accommodative, we would be at rates below 1.9, 1.8. It might come if the economy is slowing down more, right? It might come for bad reasons. So this is basically a level that is supposed to be accommodative enough in order to give more breath to companies to take also credit and basically avoid also some of the insolvencies that could have come because of the repayments that are due, right? Because a lot of the companies have taken debt over the past years, and the debt arrives to maturity in 2025 or 2026, right? So having rates lower, already anticipating that, it's good news. And you see that we still have a long way to go when it comes to investment from firms. Portugal is better placed again than the Eurozone overall. Eurozone overall has been surprising on the downside. It's a lot about Germany and a lot about Germany and France, sorry. So we are at 7% below pre-pandemic, but you see that Portugal has been very resilient over the past years, right? And again, it's explained by the next generation EU funds, from the absorption of those funds. It's also explained by the fact that fiscal policy has been more supportive, and by growth in general, which has also been surprising more on the upside. And before I close the presentation, because we are quite late, I just wanted to talk a bit about insolvencies. So, you know, Allianz Trade is having a system of monitoring day to day, right? And we in the economic research team take those data that is coming up to us and we aggregate it in order to measure business insolvencies. Because it's one thing to measure the number of insolvencies in terms of frequency, right? It could be SME, it could be a mid-corp, it could be large company. And another thing is to actually understand the severity of those business insolvencies. And this is what you have on the chart on the right. Basically is the number of cases of major insolvencies, so companies that have a turnover above 50 million euro by sector in H1. It's important to know that in the second quarter of this year, we have reached the maximum level of major insolvencies, so severity, since 2015. So we are at the highest level since 2015. And we know that 2019 already was not great, right, in terms of economic cycle. And you see that a lot of them are happening in construction, in retail, metals, services. So construction is not only about a lot of SMEs and a lot of number of insolvent companies, but it's also sometimes about large companies. And if we look at the 2025 forecast, you will see that a lot of the countries, in Europe at least, are in the decreasing path, right? So you see them in green or yellow or in these buckets, just because they have reached already very high levels, right? If you look at, for example, UK, we have it there, Poland as well, Germany is still increasing next year, but it's already at very high levels. So it means that the level of business insolvencies is 15% above pre-pandemic average. And then you also, if we look for large economies, we can also look for China. China is in the bucket of increasing, but from low levels, similar to Portugal. So we do expect business insolvencies to increase in Portugal, but from low levels, because contrary to other European companies, there have been procedures in Portugal to slow down the direct and immediate liquidation of companies, to build up more restructuring, and that has protected to some extent also employment, right? But now we do see some of those also post-COVID measures fading away, so there are reasons to actually believe in this 5% increase in business insolvencies, but again, it's from low levels. And then if we look for the US, we also see that the US is much worse, right? Which brings me to the last slide, which is, okay, we have Portugal, but we also have export markets of Portugal. And it's interesting to see that in 2024, there has been quite a high non-payment risk level in Portuguese export markets, main export markets. So we take all the export structure of Portugal and we plot our forecast for those economies. And you see that it was plus 23% in 2024, much more than the global index, which was plus 11, and also much more than in Portugal itself, where actually business insolvencies did increase, but from low levels. And we expect them to actually decrease in 2025. So bottom line, it means that it should get slightly better on the export markets, just because the worst starts to be behind us, right, in terms of normalization of credit risk. And again, having interest rates lower, it also means that non-payment risk should be lower, because there is always a sensitivity of, for example, 1 percentage point of lower interest rates means 2 percentage points of lower insolvencies, right? So there's a good correlation into that in some of the markets, especially in Portugal or Spain, where interest rates are variable. So something to look at, but yeah, clearly we see a bit of moderation ahead. It doesn't mean everything will be perfect, and as always, non-payment risk, you need to be very granular. But this is the aggregated view, if you want. And with that, I thank you for your attention and your patience.